watching Stock Watcher this week with me, Zinati Kuma, and joining me to unpack your stock-related questions is Shane Watkins from All Weather Capital. We are pre-recording the show, but still do keep sending your questions that we can answer them next week via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, Shane. Shane, I would have thought that there maybe would have been a little bit of I don't know, some participants in the market not being too happy that the South African Reserve Bank didn't go with a big-sized cut like the Fed did, but seeming that everybody's happy.
So, Zanati, good afternoon and good afternoon to your listeners. I thought the Reserve Bank governor articulated their position very well when he said, adventurism is not part of our monetary policy toolkit. And I think one of the key tenets of monetary policy is that it must be predictable. It's very bad to have monetary policy that surprises market participants. And in that sense, I think the Federal Reserve have done a less good job than the South African Reserve Bank. In the case of the Fed, people weren't sure whether it was going to be 25 or 50. Eventually, they went 50. That left half the people surprised and unhappy. And that's never good for monetary policy because it doesn't let the markets do the heavy lifting for you. When the markets accurately anticipate what you're going to do, the yield curve does the work for you. In the case of South Africa, our governor did exactly what everyone was expecting and cut by 25. And the forward yield curves are suggesting that there will be another 4 or 5 cuts of 25 basis points over the next 12 months.
Well, Shane, actually some very interesting developments happened in terms of JSE companies this week. Let's actually start off there with Amplats. Of course, there was that placing of shares by the parent Anglo American. I think 5% of the Amplats is, shares are out. Just talk to me about that and really just how the markets reacted and if this is just a good story and a good story for whom.
So, Zanati, Anglo American owns 77% of Amplats. They sold 5% into the market, bringing their effective stake below 75. I would say two things about this from an Anglo-American shareholder perspective. In the first instance, it wasn't expected. So clearly Anglo-American are not communicating their story to shareholders in a way that shareholders know what to expect. And in the second instance, in order to get this placing done, it was done at a huge discount, over 10% to the spot price. However, there was speculation leading up to this that already pushed the share price down 5%. So this was essentially sold at a 15% discount into the market at 515 Rand. I think it was great for people that were able to buy shares at 515 Rand, and we benefited from that ourselves. So I guess we shouldn't complain because the share is now 600. But the reality is that it was it's hard to understand what Anglo-American strategy is in selling down the share because every time they sell down, they put a lot of pressure on the Amplats share price. And I guess the one thing that I would say, coming from a corporate finance background in the past, the one thing you must do if you're going to sell an asset is not say you're going to sell it first.
I hear you on that.
Otherwise, people front run you.
Yeah. Well, Shane, actually, it's quite interesting because you talk about the share now being up Amplats, and it's not just Amplats. It was actually the whole platinum sector. Was there a specific reason why there was such a roar in that sector this week?
Sure. Well, the palladium price has rallied from about $900 to almost $1,100 an ounce. Now, there are various reasons why palladium should rally, and I don't want to hold myself out as an expert on precious metals, but one of the reasons is that there is a 300,000 to 400,000 ounce short position in palladium in the United States, and palladium is only about a 2 million ounce per annum market. So the short position is called 20% of the total palladium market. So there are a lot of shorts in palladium in the first place. In the second place, there's emerging evidence that kind of EVs as a percentage of the total global vehicle market have peaked at about 40%. and either internal combustion engines or hybrids both take platinum or palladium. And so they will in some sense stop losing share to EVs, and that's good for platinum and palladium. And then I guess the final reason is that, the Fed cut interest rates by 50 basis points. Lower interest rates in America tend to mean a weaker dollar, and all commodities are priced in dollars, so you tend to see the dollar price of commodities go up. And as I said, over the last week, we've seen palladium go from, call it 900 to 1100. And that's driven a huge rally in the underlying commodity shares. I mean, I think Impala's up 40% over 10 days, off a low base, but still.
Shane, while we're talking about shares that have roared, we also do have the retailers, particularly today. Is this all because of the interest rate cutting cycle, particularly Truworths being the leader there in the gains that we're seeing in the retail sector?
So, Zanati, you're absolutely right. Truworths, Foschini, Mr. Price, they're all up sort of 5 to 6% today. And year to date, they're all up roughly 40%. So among the best performers on the JSE. The reason for this is, I guess, twofold. The first is related to the improving economic and political situation in South Africa, and the second is related to global monetary policy. If we first look at South Africa, with the government of national unity, there's much greater consumer confidence. We seem to have resolved issues around load shedding. The Reserve Bank's own estimates are that load shedding costs the economy between 1 to 3% of GDP per annum. They estimate that the problems at Transnet cost the economy between 75 basis points and 1.5% per annum. So if we just take the midpoint of those ranges, just fixing Eskom and Transnet will add 3% to GDP from here. So, we've had 10 years where the economy has grown less than 1% on average. We're now going into a period where the economy could grow at 2, 3, 4%, and that's extremely good for the retailers. There was also a Morgan Stanley conference this week that had almost 400 attendees, where the new Minister of Home Affairs spoke, and he spoke about how they're going to accelerate the visa process for skilled migrants to come to South Africa to grow the economy. So, answering your question in a very long-winded way, things in South Africa just look a lot better, and the growth prospects for the retailers look much better. And then on top of that, as we said earlier in the program, the Fed cut 50, our SARB cut 25. Lower interest rates are good for retailers in two senses. It's good for their consumers, and it's good for the retailers because they tend to have a little bit of debt on their balance sheets.
We'll talk about better economic prospects there. Of course, that should lead to, I guess, a better landscape for construction. There is a question here on which local SAGNU play would you be going for there in the construction sector?
So, you're hardly spoiled for choice in the construction sector in South Africa. I would say there are really only three companies you can choose from. There's Raubex, Afrimat, and probably Wilson Bailey. If you go back 15 years prior to the Soccer World Cup, there were a very large number of other construction companies that have virtually disappeared market cap-wise. I'm talking about the likes of Murray & Roberts and Avenge. So now, the universe of shares that you can invest in is these three construction companies that I've explained, and also probably PPC, which is a cement manufacturer. I think all of them will do pretty well, but I think for different reasons. Afrimat is more an aggregates and raw material supplier, and Raubex does infrastructure and roads. And actually both of them are, I think, decent quality businesses with actually above average management.
Let's go into tech or process, to be specific. Is it cheap if a Chinese recovery or stimulus from the Chinese government were to correct current negative China sentiment?
Yeah, that's a great question. China has been a graveyard for investors over the last 5 years, I'm sad to say. and Chinese shares have derated enormously. I mean, to give you an idea, the average large cap Chinese share trades below a 10 PE. Some of them trade they trade between a third and 100% of their market capitalization is cash. Almost all of them are doing share buybacks. So, despite the bad news coming out of China and the lack of sort of urgent policy response by the CCP, these shares are cheap and it's hard to see significant downside from here. Process's main asset, of course, is Tencent, and Tencent is one of the largest e-commerce companies in China. And Tencent have come out with extremely good results. Um, since the last set of results, despite the results being extremely good and the company doing a share buyback, the share is basically flat. But it's not flat for company-specific reasons. It's flat because of a lack of appetite for Chinese exposure. So I would say, to answer your question, I would buy Naspers, I would buy Prosus, and I would buy Tencent. If you're buying Naspers and Prosus, you're buying them because Prosus trades at a 35% discount and Tencent a 45% discount. But any of those three would be good opportunities to access exposure to China, which does look cheap.
All right. Well, let's go into retail, but grocery retail. Now, Pick n Pay. I need help in deciding to hold on to my Pick n Pay shares or not. Firstly, what do you need to consider there, Shane? The viewer goes on to make an example of this process of separately listing Boxer, comparing it to that of Transaction Capital and We Buy Cars, saying that spinning off the crown jewel in Transaction Capital turned out great with We Buy Cars.
So Pick n Pay will approve next month the unbundling and the IPO of Boxer, and that will then happen sometime in November. We think that Boxer will trade on an extremely high rating. The rating that retailers attract tends to be highly influenced by their operating margin. Now, Boxer's operating margin is 5.6%. To give you an idea, the best-in-class retailer, ShopRite, is about 5.2, 5.3. So Boxer actually has a higher operating margin than, let's say, the best-in-class retailer in South Africa, which is ShopRite.
Yeah.
So Boxer could attract a very high rating, and I think there's going to be a mad scramble to get Boxer shares when Boxer is unbundled. Also bearing in mind that, let's say, the likely market cap of Boxer is going to be 25 billion, and they're only unbundling 25%. So there's only going to be 6 billion rands worth of shares available. And so I think it's going to be very high demand and it's going to attract a very high rating. I think you could buy Pick n Pay on that alone, but I think the evidence appears to be, and let's call it green shoots, that the core business of Pick n Pay is turning around. At the same Morgan Stanley conference I referred to earlier, I spoke to some of the property companies, and a number of them indicated that in their shopping centers, they had seen some turnaround in the core Pick n Pay retail business. If we end up in a situation where Boxer gets a very high rating and the core Pick n Pay business turns around, I would say even from here, there's probably 25 to 50% upside in Pick n Pay.
Well, talking about upside, we've also seen quite some upside in the property sector, as you were talking about it just now. But I mean, yeah, do you think that it's still got more legs to go, and that maybe investors who are not in the property sector should maybe start thinking about taking a little bit of a nibble?
So, Zanati, I think short answer is yes, despite the property sector being up, I think 25 or 26% year to date. The reality is we've come out of a period of very high interest rates, both nominal and real. And now we're starting to see interest rates declining. And that will push money out of long bonds, where, at one point in South Africa, you were earning nearly 13% on a long bond, and that has come down to 10%. That will force money to look for other opportunities, including property. And I think that the property sector still looks, reasonably valued, given that, the yields on property are well, I mean, you can buy property companies between an 8 and a 13% yield. And mostly what you get in property, which you don't get in a long bond, is some kind of growth vector. You know, they can add more shops, add more shopping centers, add more space. So property has a growth vector where a bond just gives you the same amount in perpetuity, or not in perpetuity, but for the period of the bond, and then you get your capital back. So the way we look at property is we think that property shares should trade on the long bond yield of, let's say, 10%, minus a third of whatever the growth vector is in that share. So let's say that share can grow at 15%, a third would be 5. 10% is the bond yield, 10 minus 5 is 5. And a lot of these shares are trading at 8%. So, you know, we still think that there's reasonably good opportunities in property still from here for capital appreciation of the shares.
All right. Well, Shane, talking about opportunity, let's get to your stock pick for today. Where are you seeing more opportunity?
So, Zanati, my stock pick today is Nike. Nike is the very well-known American footwear apparel company, and their previous CEO, he was only there for 4 years. He took Nike away from being a business that focused on product innovation um, uh, and partnerships with retailers, and he tried to sell directly to the consumer. So he went around their retail partners, companies like Foot Locker.
Yeah.
And that obviously antagonized Foot Locker enormously, and it confused the market about where you should be buying your Nikes. They have reappointed Elliot Hill. Elliot Hill was with Nike for, I think, nearly 30 years. He has come back, and he will take this business back to its basics, back to the genetics of Nike, which is product innovation and partnering with retail partners. The share has done pretty badly, you know, under the tenure of the previous CEO, and you know, it's down from kind of $120 to 80. So we still think that there's decent upside in this. And just before this interview with you, I was actually on the line with Sean Summers, and I was joking with Sean that Nike had to bring back Elliot Hill in the same way that Pick and Pay had to bring back him. And both of them are guys in their 60s and 70s, and they've come back to fix businesses that someone else has taken off track. And Dawn was joking that experience beats energy any day of the week.
Okay.
So, you know, there are a number of instances where retailers are calling back previous CEOs to take them back to their core genetics. And in sort of the same way that Sean is taking Pick and Pay back to its core genetics, the new CEO of Nike, I think, will take it back to its core genetics.
A shoe dog and a grocery dog. Thank you so much for your time and for your analysis today, Shane. That was All Weather Capital's Shane Watkins.